Hi, everybody. My name is Stephanie Billions. I'm with Cross Country Mortgage. I've been a local loan officer here in the Temecula Valley for over 20 years, and I'm a military veteran. I was in the United States Navy. So I have a broad history and a level of experience to where I can help you ascertain the best loan for you. So whatever you have questions for, Joel, I'm here to answer.
Okay, perfect. So let's just get right into it for everybody. Don't want to waste your time. So the first question I had, and this is just a concern, that I've seen in the last 3 to 4 months, especially because when people own a home and they want to buy one and they're contingent on selling their home, it's almost impossible. It's impossible almost to get an offer accepted when you're not contingent. So when you are contingent, it just makes it that much more difficult. So I was wondering if you had any updates or loan programs that could help these people get in a home and basically not be contingent on selling their property.
Yeah, Joel, we have a great new program. It's kind of I would call it a hybrid bridge loan. If any of you have heard of a bridge loan, it allows you to actually purchase a home without selling your home first. You're able to essentially not count that mortgage payment. So the house that you're exiting. Typically, it's hard to afford the mortgage on the house that you're exiting plus the house that you're purchasing. And most buyers oftentimes don't qualify if they're trying to purchase a home and not sell their home first. So what Joel's referring to is exactly that. I have a loan that would allow you to purchase a home without selling your home first, and we don't have to count the home that you're exiting, that mortgage, plus the home that you're purchasing. We would only count the home that you're purchasing, the new mortgage. So there's some guidelines that go into that, but I'd be more than happy to answer any questions that you have about it.
Okay, perfect. Obviously, that's going to be a huge help for people. And again, everybody, I'm just going through these questions pop up now and then for me, and I just write them down. And so whenever Stephanie and I get together on the video, I just have them all written down for her, and hopefully she can, has some understanding. I'm sure she will. But the next question I had was, I read something about some changes in the FHA student loan payments. Can you go over that with the viewer, please?
Absolutely. So many of you out there probably have student loans. Student loans are a burden to a lot of home buyers because what happens is you're looking to purchase a home, prices are up. You're like really pushing the cusp of qualification. So what has happened is FHA in the past would require that we count 1% of the balance of the loan, even if the loan was in deferment. So oftentimes buyers think, hey, I don't pay anything monthly, so because my loan is in deferment. And then we unfortunately have to tell you, well, we have to count 1% of your balance. So if you were to owe $100,000 in student loans, that's $1,000 a month that we'd have to actually count against you. Now, with the new guideline that has already gone live, we only count 0.5%. So that's cut that in half effectively. So if you, in that same scenario, if you owe 100,000 instead of the old guideline of $1,000 a month that we'd have to count against your debt to income ratio, is now only 500. So that's super beneficial. $500 a month is $100,000 in buying power on a new home.
Oh, wow. Okay. That's crazy.
That would keep you from being, that would allow you to buy, let's say you were looking at a $500,000 home. Now you could afford a $600,000 home.
Okay, nice.
So that's huge. Another piece to that is if you have loans that are in income-based repayment, okay? Now, again, some of you won't understand what any of this means, but if you do have income-based repayment loans, it's called IBR, with student loans, that means that the government stepped in and said, hey, we're going to modify this payment for you. We're going to lower it for you, base it on your income. If you have that, now we will count whatever's on your credit report for that situation. Okay. So if you've had some type of a modification to your student loan, you're not in deferment, we're going to count whatever's on your credit report, even if it's $10.
Awesome. Okay. Next question. Obviously, another big plus for buyers is being able to close quickly. Can you just go over, how fast can you close a loan? Bottom line.
Absolutely. So in today's market, you're exactly right, Joel. You need to be able to leverage uh, not only that contingency to sell, like we talked about, but also closing quickly and being able to compete with cash. Cash buyers can close in a couple weeks, 3 weeks. We have a program now where we can close in 3 weeks. Called our fast track program. So what it does is it essentially front loads everything. So what we do is I get with you, we fully approve your loan, we send it to the underwriter, they sign off on it. So when I give your client, Joel, a fast track approval, it means that all I need is a executed contract, a the title work, and an appraisal. That's all I need. So then that, as you can see, most of the legwork is done. We can wrap it up in 21 days or less.
Awesome. Okay. And everybody, all of these things, if you're a home buyer right now, all of these things add up. Not being contingent on selling, closing, closing in 21 days, not asking the seller for basically anything. And these are all things that are going to make you more successful when putting in offers. Absolutely. Number 4, in regards to questions. Okay. Yes. This is always a question I have because I'm self-employed, but for self-employed people or retirees, do you have any programs that at this moment right now that can help them?
Absolutely. So I have bank statement programs for self-employed borrowers. What we're finding is self-employed borrowers or business owners have been kind of sidelined due to different reasons, whether it be COVID or maybe they didn't, their business didn't, they don't have W-2s or pay stubs, and those types of programs were really removed, and they hadn't come back for quite some time until now. Since 2008. So we're starting to see those programs come back where we can do it on 12 months of bank statements or 24 months of bank statements and qualify you. So we essentially take the balances, we add them all up and divide them by whatever number of months it is. So that would be your monthly income. So which is very, very beneficial. And then for retirees, I have a couple things that come to mind. One would be our asset depletion program. That allows a client, let's say a retiree, or anybody really, that has enough assets, let's say $1 million or more, that are liquid, meaning they're in the stock market or they're in the bonds where we can actually access them. We can actually use that $1 million and average that over a period of time, and that would now become a monthly income. So you wouldn't even need to have a monthly income on paper. You don't have to take any draws. It's not required. We would just assume that you have enough to cover the period of time.
Oh, nice. That's cool.
Yeah.
So in regards to down payment on the self-employed, is that 20%, 10%? What down payment is that?
We do have programs with 10% down. So that would be something that would be allowed, 10% or more.
Okay. Awesome.
Yeah. Mm-hmm.
Okay. And then finally, can you go over, everybody hears, what your FICO score needs to be. I always hear 620. Can you sort of go over FICO scores and, help people out, not only talk about FICO scores, but, maybe interest rates, and are they a little lax now, or just go over all of that.
Absolutely. So that's a great question. And what's happening is a lot of times you hear that, hey, you got to have a certain credit score. It's got to be a 620 on a conventional loan, or it's got to be you can't go any lower than 620, period. The bottom line is that when a lender tells you that they have no loans that go below 620, that means that they are not following Fannie Mae, Freddie Mac, and HUD guidelines. That means they're adding a lender overlay onto their guidelines. So with us here across country, we do not have lender overlays when it comes to credit scores. We don't have any lender overlays. So if you're doing a conventional loan, you would need a 620 score. That is a standard FHA, Fannie and Freddie requirement. If you are going FHA, we don't have a credit score requirement. Whatever DU or desktop underwriter approves, which is a digital underwriter, we will go with. So, and then with VA, there's also no credit score requirement either. So we follow that as well. So bottom line is if you have an interest in buying a home, just, call Joel. He'll put you in touch with me and we will make it happen.
Awesome. I never knew that. I mean, this is all, I'm glad we met. I'm glad today. I'm glad you got these questions answered. We were talking at the beginning of the video that we should be doing this every month. Yes. So if you are, first of all, new to the channel, Exploring Temecula, we do videos every month. We're really going to try and meet every month. And these are important. If you're looking to purchase a home, these are very important videos, keeping up to date on the guidelines of your personal situation. So appreciate everybody watching the video. If you have any questions, you can either get a hold of myself. I'll put my number in the video below, and I'll also put Stephanie's information on the YouTube video. But thank you for watching, and thank you very much, Stephanie. And hopefully we can get some people buying homes soon.
Absolutely.
Okay. Awesome, Stephanie. Thank you.
Take care.